Kenya's economy is expected to grow at 5% this year, but additional external shocks would place East Africa's largest economy under severe stress. According to the World Bank, the actions taken by the government at the end of the third quarter of 2011, which included raising interest rates, helped bring inflation down.
We have seen that actually the economic growth, actually for a year when we had so much turbulence, we could say was relatively robust at 4.4%. But we can see that it's the services that were driving the economy. Growth of the services sector was at 5.1%, industry at 2.8%, and we actually saw the slowdown in agriculture. And given that it's still the large sector of the economy, that's why we saw that sort of drag growth down to 4.4%. So in a sense, given the turbulence, we still think that was an average performance. But also looking at the quarterly performance, you can see that growth was balanced throughout the year. We didn't have such huge fluctuations that we saw in 2009, where we had almost a complete slump in some quarters. But in 2011, we can see that growth was relatively balanced throughout the year.
The rapid growth of East African Community, which is one of the fastest growing regions in the world, is offering the country an opportunity to maximize on trade. The region grew by an average of 5.8% in the past decade, recording the second highest growth rate of any economic bloc.
One of the challenges for Kenya and the other countries in this region is to diversify their exports. I think that was one of the issues that was raised on the macro framework, that when exports are concentrated on a very few products, you become vulnerable to shocks. And also, a lot of those exports, although they've been growing, they haven't been delivering jobs. Jobs is one of the key things that the region, that Africa needs to deliver more for the growing numbers of young people who are entering the jobs market. So regional trade is an opportunity to diversify exports. Why? Because, well, the region is growing, and growing markets offer up new opportunities. It's also the markets are proximate, so that the costs of exporting to your neighbours in terms of transport should be less than to exporting to Europe and the rest of the world.
Kenya's external position is, however, vulnerable to shocks, as evidenced by the widening current account deficit. The World Bank projects it to reach 15% of the gross domestic product this year.
But there's one big challenge, which is the current account deficit, which is almost double now than it's in Greece, and which is the iceberg underneath the exchange rate volatility of last year. And what's happened now is just that there's a stabilization through the short-term money and the short-term financial flow that has come in. But the underlying challenge is for Kenya to become more competitive in exports. Kenya cannot grow rich on tea and flowers alone. If oil price, the single most determinant of the current account deficit is the oil price. The oil price is structurally higher now this decade than before. It's now still around $100 a barrel, despite the global volatility, which is quite high. And if other things come into play, especially a type of crisis in the Middle East, as we saw last year, then oil prices could go up, even though the global economy does not pick up. And that's very challenging for an economy like Kenya, which depends on oil imports.
The ongoing Eurozone crisis could also impact on the country's growth if the global economy remains sluggish. Currently, Kenya supplies 55% of the flour sold at the Netherlands auctions and 40% of the produce in the EU.
Europe is still one of Kenya's main trading partners, especially in the top two exports, flowers and tourism. So if Europe is in crisis, it's likely that Europeans may cut back on flowers and on vacation, which would impact Kenya. At the same time, Kenya has started to diversify, especially in tourism, where Asian tourists are starting to come in much bigger numbers. So that's one aspect of that balancing of the tightrope that we highlighted. The other is Kenya is not as integrated in the global economy as other parts of the world, say South Africa. That's why it was not also as hurt by the last financial crisis, 2008 or 2009, and could buffer itself much more strongly. A challenge in the south of Europe alone won't create a big hit on Kenya this year. But if the global economy continues to be sluggish, if the Eurozone crisis disintegrates disorderly, if that has an impact on Chinese growth, probably US growth, then the whole world will be in trouble, and that would include Kenya.
Attention now shifts to how the country will manage its election, support private sector efforts to increase manufacturing and exports, as well as remove bottlenecks to spur regional trade. Reporting for Eye on Kenya, I'm Ken Karuri.